take two. I was sharing my screen in the previous broadcast and hit the stop button instead of the stop sharing. Overnight, the Fed passed. That set the cat amongst the pigeons for traders in some markets. The Fed signalled that it was worried about conditions abroad, that inflation was not a problem. It downgraded its growth forecasts. And what we saw an initial rally in stocks, but then that reversed. We saw the Aussie dollar rocket higher and then get slammed. And the only major market that actually benefited and stayed with that benefit were US interest rates. The US 2-year interest rate rallied 14 basis points, which is about a 17% capital gain for those who were long. Anyway, quickly, what the Fed did was highlight that it is concerned about offshore. That gives us a feedback loop for emerging market weakness and, pardon me, and Chinese weakness. And as Emma Lawson from National Australia Bank said, the thing to note is the circularity of this problem. They don't hike because emerging markets are under pressure. Emerging markets are under pressure because the Fed is going to hike. If the Fed doesn't hike, then emerging markets rally. The Fed turns hawkish again, emerging markets come off, and so it goes. So we need a circuit breaker. They really have put a bit of a sort of Damocles over their head with that comment. It's only a couple of lines. They can be changed, that sort of stuff, but we'll have to see what happens. But part of what we saw last night as well was we saw that Janet Yellen, unlike many other Fed governors, is a bit of a hawk when it comes to the US dollar. And what we see here is we see that this is the rally that we saw in the Aussie dollar, which was up about 120, 130 points from the lows at one stage last night at 72, 70, 80, and then it sold off pretty quickly in the following hour. And part of that was that there had been a sell-off, a rally initially, and then a sell-off in the S&P, which you can see here, and a big range in that, a big range in this second last hour, and then a big pullback. So it actually finished lower. Now that's important because what that's done is it's really made it interesting and difficult for stock traders, and ultimately that's the key to everything at the moment, is what stock traders think. And so if we have a look at the setup that we've got now in stock markets, we can see that we've had some failed wedges. Now, whichever way we go, we're going to go for a big move. This top left hand is the S&P 500. So we had this break and then it's sold off. This is the Dow down here. This is the ASX, and this is the UK. So it's not overall bearish or overall bullish, but we have seen a failed break. So watch that downside. But if you think about it, if rates in the States are going to be lower and stay lower for longer, and it looks like 2016 is firming as the market's favourite for a rate hike now, then that's a lower discount factor for stocks. And so that does support stocks at the margin. And while ever the US economy is doing well, we probably can get more of this, strength-ish in the US economy feeding through into markets that won't necessarily fall out of bed, that probably won't rally either. So that there's an air pocket on the S&P that's probably goes all the way up to sort of like the 2070, 2080 region, which the S&P could easily fill and still be in an overall bear market. If you have a look at the euro now, after rallying quite strongly up to 114.5, it's back down at 113.95 at the moment. And under a little bit of pressure, sterling's back down at 155.60 after being up at 156 earlier. So what we've got is we've got a market that's trying to work through the tea leaves. What does it really mean? Would you really buy euro over the US dollar at the moment? I know I wouldn't. QE is going to be happening in the US, in euro for a very long time. But as the tea leaves settle and as the market settle, I'd expect some more volatility over the next few days. And so I know I say it all the time, but it's still a period where you need to be really careful. The Aussie, pardon me, still got that flu. The Aussie failure up there at 72.80 will undermine the bulls, but from the daily chart point of view, my bias is still that the Aussie will head a little bit higher. This is my second take on this, so hopefully I've covered everything. But keep an eye on how Asia trades today. What we saw with the sell-off in the US was that the ASX gave back all its gains, and it was up 1.5% at one stage last night, and ended flat on the night. So there could be a little bit of pressure there. The Nikkei is going to have some gains from yesterday. It had a good day to give back, and that could influence China and Asia. So don't be surprised if you see a risk-off day in Asia today, which will put a little bit of weight on the Aussie and others. Yesterday we said that the Aussie would get back down to 71.40. It did before the rally. So it looks like it might be under a little bit more pressure. So have a nice weekend. I'm Greg McKenna. You can catch me on Twitter. Bye for now. All the best.